Good morning, everyone, and thanks for joining us. I'm really excited to be here with our three guests, Kevin, Christopher, and Jill, who together have been at the forefront of innovation around how to raise finance for nature protection and doing so while helping to alleviate a country's debt burden. Together, about 18 months ago, they helped pull off the largest ever so-called debt for nature swap in Belize. This enabled Belize to buy back a large super bond from the market at a discount and allocate some of the savings towards marine conservation. The country did so with a loan from the Nature Conservancy, which itself raised finance from Credit Suisse, which in turn raised funds via the market through the issuance of so-called blue bonds, a kind of tiered crediting structure. The Nature Conservancy has since done a similar deal in Barbados, and there's others on the table as a growing group of countries globally look to sidestep default and meet their commitments to protect 30% of land and sea by 2030. Christopher led on the deal from Belize, and Kevin led on the financial component from the Nature Conservancy with advice from Jill's sovereign debt advisory firm, Potomac Group. Thank you for joining us today.
Thank you.
So, Christopher, what was the economic outlook for Belize in late 2020, and why did you look favourably upon a debt for nature swap against other options on the table?
Well, economic outlook was certainly grim. We were in a deep crisis, fiscal, economic, debt crisis. The economy had already been in contraction at the time of COVID, but COVID simply exacerbated that situation where we were contracting around 13%, not unlike many other countries, but for us it was certainly difficult. We were already in debt distress before COVID, and COVID only made it far more worse. Our debt to GDP ratio had increased to around 133%, one of the highest in the entire Western Hemisphere. Altogether, our revenue, government's revenue suffered a fiscal shortfall of around 30%. We had to keep spending for pandemic-related expenditures. The net result was that we were suffering an overall deficit of double digits. The unemployment rate approached close to 30%, and our poverty rate was in excess of 50%. So certainly we didn't have much choice but to look at how we restructure our debt, among other things that would put us back on a good footing so far as fiscal consolidation was concerned.
And why did you look towards a debt for nature swap, so to address both the debt component but also nature protection in the country? Why was that a favourable option for you?
Well, we have had a pre-existing relationship with the TNC for many years, for decades. I think the first debt for nature swap that TNC did was actually with Belize about 20 years prior. And TNC had, over the many years, expressed an interest in doing a larger deal with Belize. A new government at the time, in late 2020, it was imperative that we take immediate action in debt restructuring. And so looking at what our debt position was at the time, we felt that we had to negotiate with our external creditors. That was a sizable portion of our overall debt. So we started that process immediately. And at the same time, on a parallel basis, then we initiated negotiations with the TNC to look at how they could play a role in our overall debt restructuring process.
Okay. And Kevin, what were the key ingredients you needed to pull this off? And the Belize deal was not only the largest, but it also involved some novelties to these kind of debt for nature swaps that have been around for a while, in the sense that it opened it up to a pool of institutional investors, so pension funds and others. What were the key ingredients that you needed to make that work, and what were the challenges that you faced in doing so?
Sure, thanks, and thank you for inviting us here today, and Bloomberg for hosting this. This was an evolution of the debt for nature swap, which had been around and started in the 1980s, was popular in the 1990s and 2000s, and as Minister Coye said, TNC did their first with Belize, so in 2001, and we had this 3-decade relationship with Belize. We did a transaction in the Seychelles, which was kind of a half step in 2016, which was reprofiling the Paris Club loans to the Seychelles. But what we discovered in that transaction was that getting the discount or the haircut was difficult to do, and it was a long negotiation with the bilateral creditors. And yet we could find that discount readily available in the capital markets with the bonds. So we started putting together a program to figure out how we could work on credit enhancing bonds to buy back bonds at a discount, and then using that savings to finance the conservation that the countries wanted to achieve. We worked with a few countries, and what you need is we were exploring with a few countries, and we had spent a long time working with the Development Finance Corporation of the United States to set up the credit enhancement. We had already tendered out for the investment bank to do the arranging, and Credit Suisse had won that before we even started the Belize transaction. But with our relationship and with the Belize currently, at the time, was in negotiations with their bondholders, and their bonds were trading at a deep discount, we saw a great opportunity to bring all of these parts together. And what really made it happen was that Belize, because of our relationship with Belize, we knew that Belize had high ambitions for conservation and a high commitment. If you look at Belize and how much they've committed on the forest side, TNC has been involved in that, and they had the commitments on the conservation commitment desires on the ocean side. So we had already made great progress on that, right? Because that is outside of the financing, but needs to go into the loan documentation. So everything kind of came together, and then there was an election in Belize, and a new administration had come in, and that's when we started working on that. Now we really had serious conversations starting in January of 2001, and then we closed the transaction in early November.
Okay. And Jill, Belize was in debt distress at the time. The Nature Conservancy has since done a similar deal in Barbados, which wasn't in debt distress. There's been some discussion around whether debt for nature swaps are best suited to countries that are in debt distress or countries that are not in distress situations. Could you just talk a bit about your views there and how that debate lies?
No, absolutely. So first of all, I'd like to say that the IMF has recently come out with a paper that said that there are 59 countries that are most vulnerable to climate change. And of those, 34 countries are also at high risk of debt distress. And so the coming together of these two crises is well known. And the countries themselves are starting to organize, and they're starting to say that we need to solve these crises simultaneously. So we already have an organization called V20, which is the Climate Vulnerable Forum, which now has 58 countries, about 2 billion people in its population. We have the Sustainable Debt Coalition that was announced by Egypt at COP27. And we have the Bridgetown Initiative coming out of Barbados. And so countries themselves are linking these issues and are pushing the international community to think about it in this way. And they have been saying very much that the situation is getting worse. The vulnerabilities are increasing. The uncertainties in the market, particularly with geopolitical tensions, the war in Ukraine, food insecurity, rising interest rates. We need to think creatively about these solutions. And so the Belize transaction really starts to point a way forward of saying, this is what ways that we can think creatively and bring in these innovations. And then the challenge is how to scale it. And at the same time, our frameworks for debt restructuring, particularly the G20 Common Framework, are also not working. So while we're trying to figure out how to mobilize climate finance to scale and to meet our commitments of advanced economies, we're also at the same time trying to rewrite those frameworks. So kind of bringing these together makes sense. But just also, whether you're a country in distress or not in distress, the fundamentals of debt management are that you're trying to either raise finance for new projects and new investments, or you're trying to refinance existing debt. And you're trying to do that at a lower cost and at lower risk. And so that's meaning lower coupons, longer maturities, ideally in local currency, and ideally you're also addressing counterparty risk so that if you are in debt distress, you have the ability to negotiate with your creditors and reach a solution, a resolution. And these structures that we're talking about today actually address all of those issues. And so they're quite powerful tools to have in the toolbox. It may not yet be the solution that solves everything of either climate finance or debt distress, but it is certainly a very powerful tool to be using, particularly with certain creditors or creditor groups that might be particularly difficult or negotiations that are stalled. So I think these are not exclusively for debt distress situations, but they can definitely be used in all situations where, as Kevin says, you have that discount in the market, because it's really that's driving the kind of ability to capture that fiscal space for investment in climate.
Okay. And Christopher, a year and a half in, how's it going? What impacts have you seen, both in terms of on your finances and also in terms of conservation projects?
Well, first I would say that the transaction, the Belize deal, was a tool used out of a toolkit. It was part of our overall recovery plan. We restructured other debt as well. We restructured recently our Venezuela debt. We also had restructured our Taiwan debt. And through that process, we were able to reduce our debt to GDP ratio from the 133% that I had initially indicated to you to 64%. So whereas after the transaction, the IMF had indicated that it was a important step for Belize, our debt was still unsustainable at the time. Their most recent Article 4 consultation, they have indicated that no, Belize's debt is now sustainable. So it's been a dramatic turnaround for our economy, our fiscal finances over the past couple of years. Our economy has grown over 28% over the 2 years, 15% in 21, another 12% in 2022. Our unemployment rate is from the 30% that I mentioned is now down at an all-time low of 5%. We have broadened our economy in terms of diversification of our sectors, and we're doing well. We're outperforming the estimates of all the MDBs, including the IMF, notwithstanding the challenges in inflation and supply chain and all those issues. We're doing a lot better. Our debt, in terms of the transaction itself, we had reduced our overall debt by 12%. So it was a significant immediate impact. Our debt servicing obligations in the near term, as a result of the transaction structure, meant that our debt servicing reduced on just the external commercial debt, whereas it was roughly $28 million in pure interest debt that had reduced to around, I think, 10 million, a little over 10 million. So that fiscal space certainly made a significant difference in our fiscal position. At the same time, though, I have to underscore that it is not just a financial deal. It's not just the financial partners that made that deal. The government had to play a key role in exercising political will fiscal discipline and fiscal consolidation. It meant expenditure containment, which involved cutting public sector wages at 10%. We had strikes as a result of that, but we followed through, maintained our position, and that built credibility for Belize in the decision making that it went through in terms of that transaction, but showing to the not only local but the international community what the government is prepared to do and to stick to enable not only this transaction to occur, but enable investment confidence to reemerge.
Okay.
Can I just add?
Sure.
So, but I think the interesting thing is there is a debate whether the debt conversions work with a debt workout. But what Belize has done is prove that it can, but in a slow, much easier situation where it's not like a common framework where everybody's trying to solve one problem at a time. But it definitely worked well, and as the minister said, we reduced the debt 12% of GDP overnight in that transaction. So it was an immediate step. It's one solution. So it's great to see that the debt management units of the ministries of finance have this tool in their toolbox. But there have been many successes on the conservation side because we do not see this as a liability management tool. This is a conservation funding tool, right? So we're trying to help governments achieve the conservation commitments that they want to do and then come up with financing for those commitments. And like I said, we worked with Belize years before, so we understood what they were trying to achieve. But we do put that into the loan agreement, and that helps us get the credit enhancement, and that also helps with the end investors feel that these are not just plain vanilla sovereign bonds, but they're actually achieving the conservation. Those commitments are made and are time bound, and if they're not made, then there's an additional payment that they have to pay while they're outstanding. That money doesn't go to the bondholders or anything, it just goes back. But those commitments have been met, so far on time without problems, and they were starting the Marine Spatial Plan, establishing a conservation trust fund to disperse these. The Conservation Trust Fund has dispersed 2 rounds and just announced yesterday a larger significant round of programs that will be funded. And then there were even some specifics of designation of mangroves into public lands, and those have all been met on time.
Okay. So you've seen some kind of material change on the ground in terms of improving or protecting the marine space.
If I can add from a conservation standpoint what Kevin spoke to, one of the big milestones that we have achieved already is in terms of the biodiversity zones. We have increased that from 15% to 20%. We've committed to increase to 30% by 2026. And that somewhat highlights part of the importance of an alignment in terms of government goals or the country's goals. Belize is certainly very conservation oriented, and we had already committed to 30% of our ocean waters being protected by biodiversity zones. We only, under this arrangement, moved it up from 2030 to 2026. But it was a part of our commitment, and I think that is important that in transactions like these, that there are these commitments or objectives that form part of the overall policy of the country, so that it makes it easier to happen. It wasn't hard for us to make those commitments because those were our goals already.
Yeah. Okay, Jill, please.
Yeah, I just wanted to pick up on that point as well, is that one of the really powerful outcomes of these sorts of transactions is this alignment of government between the Ministry of Finance and Ministry of Environment and Fisheries and Labor and Energy, et cetera. I mean, it just really drives that interministerial coordination and actually increases governance, because you're also putting in targets, you're setting performance KPIs, and then as you're meeting those, there's all sorts of monitoring and reporting and verification. So there's actually a virtuous cycle that can be developed through these transactions. And you're also, and we were talking about it just actually before stepping out here, about creating a different narrative for the country. And it's particularly for those countries that are in some sort of distress, whether it's in a negotiation or just in a kind of market, the bond prices, you're changing the dynamic of the conversation, where instead of just talking about the difficulties that the country's having, you're taking ownership of it and talking about something that's positive and investing in building resilience, building sustainability, and the future of the country. And so I think that's a very interesting dynamic out of these transactions that is quite powerful for any country, whether in distress or otherwise.
Yeah, okay. I'm conscious we've got the time speeding by. I think before we wrap up, I would just like to get your response to some criticism that's emerged. The deal was kind of widely welcomed and has been heralded for its innovation, but there has been some criticism around both the costs associated with the transaction, the kind of the relative costs and the transparency around those, and secondly, around the labeling of the bonds at the top of the crediting structure as blue, when not 100% of the proceeds are going towards marine projects, which is the kind of norm in the sort of green bond market. How do you respond to those couple of points there? And I'd like that to open that up to all of you. But Kevin, perhaps we can start with you.
Let's see. Well, there's two issues there. One, I'll quickly start with my responses. Of the first one is it a blue bond? And the blue bonds are not quite as defined as green bonds, right? So if it were a green bond, they're what's called a use of proceeds bond, in which all of the financing would go towards projects in climate or nature, or ocean in our case. There are guidelines on the blue bonds, but those came out after our transaction that the IFC has, and ICMA, I believe, is working on it, but there's no standard. So if there is an agreed global standard on what a blue bond is and we don't fit with that, then we will adapt. And we are actually changing ours to nature bonds, because now we're working with terrestrial and freshwater as well as oceans. But it's clear that the proceeds are used mainly to repurchase the debt and retire that debt and replace it, reprofile it with a loan. And then finally on that, we're not worried about that with the investor class. If these were retail products that were being sold to families, that would be a problem. But by law, with these private placements, we can only sell these to what's called qualified institutional buyers, who are very sophisticated asset managers, insurance companies, banks. And we know all of the individuals who made those decisions. They grilled us deeply on the conservation and the structure. So I don't feel that there is any chance that anybody was misled as to what we were doing with those, because the analysis that goes into purchasing these bonds is rather intensive. On the cost side, there are two types of costs. There's the fixed costs of the upfront costs, and I think those are pretty standard with any sovereign issue, right? You have lawyers, you have arrangers, you have SPV creation and the like. I don't see that as any different than what they would have done with a workout with their new structure. On the running costs, which is the spread between the blue bonds and the blue loan, that's composed of many things. The key one is the political risk insurance that we needed to put on the principal and the interest of this transaction. So that is the bulk of the spread, and that you can look at that as a cost, but that is a great savings, because Belize's borrowing cost in the market at the time, not that they were traded actively, 20%. Yeah, it was up near high teens and close to 20%, where in the end they ended up borrowing close to 6%, just a little over 6%. So that is a massive savings for a small amount of cost. So it is a big pickup, but it is a cost. It's a cost that is common in structured products. There are other costs that, underwriting costs, for instance, that Belize, because of the negotiation, Belize had agreed with all of their bondholders that they would accept something, which means they had to finance all of their bondholders, and they needed to have it underwritten by Credit Suisse and did not take the risk of issuing the market. So these are acceptable costs they have to be in these structures, and we're doing everything we can to make those costs as efficient as possible, but this was the first transaction, and Belize really led the way on the market.
If I can highlight one item, in terms of costs, the reference to the political risk insurance and the DFC, I think that in itself actually is one of the insights that we can offer from this Belize deal, that credit enhancements play a critical part in all these debt distress transactions, risk reduction strategies, one of which is credit enhancement. And if there's a learning that we can have going forward, it is the importance or value of that, and how developed countries can play a role in supporting debt distress transactions through providing risk reduction strategies like credit enhancements that the DFC did provide in our case.
Yeah, I totally agree with that. Yeah.
Well, thank you. Thanks to the three of you. I think we're at time, but it's been a fascinating discussion, and yeah, thank you very much for joining us today.
Thank you.
Thank you.